SD Bullion shocked gold and silver investors on Black Friday last year with some of the best gold and silver deals they'd ever seen. Black Friday 2014 will be no different. SD Bullion's Black Friday and Cyber Monday deals kick off at midnight Eastern with a new holiday Silver Shield coin and the launch of the long-anticipated third coin in the Heroes SD War Collection, Secession, along with 4 brand new Heroes Proof coins. Blockbuster hourly sales begin 8 a.m. Eastern on Black Friday with unbelievable inequality and 20% off sales planned for gold and silver coins, bars, lead bullion, and survival food. Stay with SD Bullion all day as new Blockbuster Black Friday deals will be displayed on the homepage every hour. Don't get trampled in a doorbuster stampede for electronic gadgets your loved ones don't need that will be outdated in 6 months. This holiday season, why not give your loved ones a valuable gift that will last from SD Bullion? You won't want to miss the After Thanksgiving 2014 sales event at SD Bullion. Click the link below for a preview of some of the blowout deals SD Bullion will be offering on Black Friday and Cyber Monday.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is one of our good friends, Dave Kranzer. Thanks for joining us, Dave.
Thanks for having me. It's always a pleasure to be here.
Looks like a potential bottom here. Gold retesting the 1200 level here late. Trading here on Friday after trading back above 1200 earlier in the day. What's your take here overall on the markets, Dave? Have we seen the bottom?
Well, that's a good question. It seems that these lower price levels have stimulated just a deluge of buying of physical gold out of India and China and Russia. And I don't have the exact weekly or monthly numbers in front of me, but India imported a crap load of gold in October, and also 40 million ounces of silver. So to put that in perspective, the U.S. sells a little over 40 million ounces of silver in a year. Well, India imported that in the month of October. And China, based on the withdrawals being made from the Shanghai Gold Exchange, which is a true physical market, looks like they're withdrawing about between 50 and 60 tons a week, which means that there's 50 to 60 tons of gold per week flowing into China. Again, I want to point this out because every single analyst under the sun seems to rely on the Hong Kong export numbers into China as being the amount of gold that China is importing, and that is just not true. Beijing, I believe, has become a significant port of entree, and China, when they announced that they were opening up Beijing for imports, specifically said that they were opening it up because those numbers don't get reported and they don't want the world to know how much gold they're importing. So these outfits like UBS and all these other analysts who cite the World Gold Council numbers and the numbers from Hong Kong, they are way off the mark in terms of how much gold China is accumulating right now. And that would also include the 450 tons a year that they mine that probably goes right into the PBOC central bank vaults. So, and then obviously Russia, I think in October they reported 19 tons that they put into their central bank vault, and I believe in September the number was something like 37 tons. So for any of the people who buy into the narrative that the U.S. economic sanctions on Russia are hurting Russia, well, then where are they getting this money to buy all this gold if they're feeling economic pain? But anyway, to answer your question, again, I just don't know how aggressive the crooks in this country are going to get with trying to manipulate the paper market lower. They can create as much paper gold as they want to print. I do think that the physical market acts as a check on that, and I've been wrong in the past, but it kind of feels like it's a bottom here, and I think we're probably going to touch on it a little bit later, but you look at the gold forward rate coming out of London, which is they're going to stop publishing it next month for obvious reasons. But it's significantly negative, and it's significantly negative out to 6 months, and that's indicative of an extreme shortage in the physical gold market. So if this condition holds in the physical market, then yes, we've definitely seen the bottom. And I do think that more and more people are starting to understand just how crooked and corrupt the Western Ponzi scheme is. And I think you're starting to see more and more people get interested in accumulating physical metal. And I think what happened with the mint in the Silver Eagle is a perfect example of that.
And speaking of the physical market, we had a big story here today, perhaps the biggest in 3 or 4 years in the physical side, that the Dutch Central Bank has been secretly repatriating 130 tons of gold from the United States over the past year, according to the Netherlands official bank in Amsterdam. And we're talking about 130 tons, which is actually more than Venezuela repatriated back in 2011. If I recall, Venezuela repatriated somewhere around 110 tons.
Actually, let me just cut in here really quickly. The official number that was released today was 120 tons, and Venezuela actually repatriated 160 tons.
Okay, so Venezuela was a bit higher. I mean, coinciding with that, in the aftermath of that, gold saw its run up to 1900. So it's obviously a big story in the market, and you have an interesting take out today, Dave, that you believe that gold was not sourced from the Fed, but actually from the GLD.
Yes, and again, I'm not married to this idea, and I'm not saying this is exactly how it went down, but if we assume that 120 tons of gold was actually physically moved from wherever into the Dutch National Bank's vaults, I don't think it's possible that it came from the Fed, because otherwise, why didn't the Fed return Germany's gold as soon as Germany asked for it? Recall, Germany asked for 300 tons, and they actually, no one catches this, but they originally asked for more than 300 tons, and then the news went radio silent, and about a week or two later, it was announced that the U.S. and Germany had agreed on 300 tons over 7 years. Well, why was it going to take 7 years to get 300 tons to Frankfurt or wherever the Bundesbank vaults are, and the Dutch National Bank was able to get 120 tons there in a matter of months? So, in my opinion, I don't think that gold came from the Fed's vaults, although the accounting for it was probably accounted for in the Fed paper files. I think it's possible that the 120 tons was a combination of gold bars that were drained from GLD, and also let's not forget the Ukrainian, the airlifting by the U.S. military of 33 tons of gold out of Ukraine when that whole situation blew up. I think it was sometime this summer or something when that news hit the tape. I forget. I looked it up earlier. I don't remember the exact month. But anyway, everyone seems to have forgotten that the U.S. airlifted 33 tons of Ukrainian gold out of Ukraine. And I'm guessing that part of that stash is sitting in the Dutch National Bank vault. So, yeah, maybe on an accounting basis, just like everything else is paper-based in the U.S. bullion market, maybe the Fed is going to show us that it has 120 tons less of gold on its books, but that gold did not come from New York. I would bet my dog's life on it.
Don't miss your dog.
He's old, but I'll grudgingly bet his life, even though he's old.
We won't tell him.
Actually, a good point that someone raised with me earlier was why would the U.S., at least for prima facie purposes, why would the U.S. agree to give 120 tons back to the Netherlands and not send any gold back to Germany?
Right.
And again, I think I did some thinking about this, and if I'm right about the gold being moved from GLD to the Netherlands, it's easier it's easier to justify a 100-ton drawdown in the GLD vault. You know, no one really notices that. I'm probably the only one who writes about it out there. The fact that, and I've been writing about the drainage of gold from GLD for a while. In fact, the last time the listed amount of gold in GLD is 720 tons, and the last time it was that low, gold was like at $800 an ounce. So why was there 720 tons when gold was at $800 an ounce, and there's 720 tons of gold with gold at $1,200 an ounce? Tells me that, you know, gold is being removed from GLD. So, but if 300 tons were removed and sent to Germany, I think everyone would notice that, and it would raise questions. And I also think there's probably some political leverage that the Netherlands have over the U.S. that Germany doesn't have. I mean, Germany and the U.S. are kind of, you know, tied at the hip by virtue of their banking system. In other words, there's a lot of cross-collateralization of derivatives exposure between Deutsche Bank and some of the other large German banks and J.P. Morgan and Citibank, et cetera. So I think Germany and the U.S. cooperate with each other on these matters, as we saw on that agreement to send 300 tons over 7 years. And I think the Netherlands has some leverage over the U.S. that Germany doesn't have. So that would be my explanation for why the U.S. is willing to disclose that it sent 120 tons to the Netherlands, even though it wasn't really the Fed's gold, you know, in a matter of months. But they haven't really sent anything back to Germany other than that 5 tons of scrap that had to be remelted into bars. So that's kind of my take on the situation.
What may also be interesting, just throwing out a conspiracy theory that I had quite literally listening to the two of you speak about this. We had the ABN AMRO default on custody holdings for clients in their gold accounts last year. And it's possible that the Dutch government fronted ABN AMRO and tried to make them whole before that whole crisis completely unfolded. So maybe this is kind of like a payback for the Dutch saving the system back then. Who knows? I mean, admittedly, that's an entirely hypothetical conspiracy theory, but it makes sense when you kind of plug it in.
Well, if you want to throw a conspiracy theory in there, and again, I'm not really a conspiracy theory guy, believe it or not.
Yeah.
You know,
I mean, it's
I need to see at least circumstantial evidence. But
yes.
Which country is analyzing the flight MH17 black box data?
Yeah.
Netherlands, right?
Yes. And
okay. So, and which country really is interested in not having the facts about what's on that black box released to the public? Because notice it's been delayed forever. I think it was supposed to be out by last month. Which country is most interested in not getting to the truth of that? Now, I'll give you a hint. Russia just last week said, come on, let's see the data from the black box. Come on, Netherlands, where is it?
Right.
You see what I'm getting at here?
It's helpful.
Maybe Netherlands said to the U.S., send us our gold, or we're gonna vomit this black box evidence right now.
Yeah.
Again, it's just a conspiracy theory, but like I said, I think there's ways in which Netherlands has political leverage that Germany doesn't have.
And it should be said that, conspiracy theories are great hypotheses to just focus the attention for further analysis. It's not so much that, hey, let's go find something that's titillating and report it, blah, blah, blah. I mean, it's helpful to unearth further investigation and point the directions to where one digs. So, the audience needs to understand that that's why we're bringing these subjects up. It's not trying to be sensational and whatnot, but these are valid questions to ask.
Yes, I agree with that. And notice in my blog post today about the topic, I did not mention that idea. So I just said, here's what I think happened. Here's the tracks in the snow.
Yeah.
The other big story that you've been covering, Dave, is the breakdown in the Japanese yen. They've gone supernova with QE, and unfortunately, the yen is going parabolic versus the dollar. Are we seeing the beginning signs of hyperinflation in the yen, Dave?
I think it's possible. Again, I don't. We're going to have to see how this unfolds. It could be that, there's a couple different theories that I've heard that kind of make sense. I think that the QE in Japan is really a de facto QE for here, because what's happening is the Ministry of Finance is printing up a boatload of unsterilized yen. And obviously our banking system, our hedge funds and banks are borrowing those yen because it's zero cost, converting it to dollars and using those dollars to buy the stock market and treasury assets. So, and I know, I think the latest report showed that U.S. banks have significantly increased their treasury holdings. So even though the Fed has stopped its QE and it's not buying treasuries or mortgage backs right now other than reinvesting interest and maturities, the banks are loading up on treasuries. And I think the source of the funding for that is the unsterilized yen that the Ministry of Finance is printing. So there's also, I actually have a flow chart that a colleague of mine drew up that outlines exactly all of the flows. And at some point when I get some time, I'm going to sit down and do a blog post on it, because it really kind of explains how and why the printing of the yen is really a de facto QE for the U.S. Because you would have thought that once the Fed stopped printing money and buying treasuries, you would have thought that you would have seen interest rates, at least interest rates on treasuries on the 10-year and out, go higher, and they haven't gone higher. They've actually been trending lower now since the summer of 2013.
And we've seen this kind of rotation going on between central banks, primarily ECB, the UK, the Fed, and Japan, for quite some time now. It's been going on ever since the crash of 2008, where one will step up and do a lot of QE. The United States was first, and then the UK was second, and Japan is now filling the role, and the United States is backing off. It's kind of like a tag team to reflate the global economy.
Well, what's even more absurd about that is the fact that the U.S. stock market, does a moonshot on that news. If anything, if Japan is devaluing the yen against the dollar, it's going to hurt our manufacturing and help theirs, because it means that their products, especially their cars, are going to become cheaper relative to U.S. produced automobiles, right?
Right.
So you would think that would be negative you'd think that would be a negative for the U.S. economy, and yet the stock market's probably, the S&P's up, maybe 100 points since that announcement?
Yeah. And what that speaks to, Dave? It speaks to the fact that you're rational and you've been around on this planet for a long time in our new normal, where the financialization of absolutely everything globally and our economic systems are such that the short-term and intermediate-term emphasis in the financialization world has a bigger impact, and the markets react, and all of these hedge funds and so forth are dogpiling on the same kind of dynamics because everyone sees it. It actually speaks to the advanced stage of where we are in our financial markets, and how everything is just so extended, because that's what happens when we get to these disconnected valuation levels versus the real underlying economy. And we've got this illusion going on where the financial assets of our world are all out of sync and all out of balance and all in bubbles, particularly the bond market, but stock market secondarily as well. So this is it's nuts what's going on.
Today's a perfect example of that. China cuts its interest rates, and if you read the technical details of exactly what was cut and what the implications are, it looked to me like and we've been reading about, there's been some severe interbank illiquidity and financial market illiquidity over there. It looked to me like the cuts were designed to induce liquidity into the banking system there. There should have been no connection whatsoever, or no translation of that news event into our stock market, again, doing a supernova moonshot this morning on that news. If you look at the dollar-won relationship, which, by the way, that's another thing that's been a sore point with me is everyone's talking about how strong the dollar is. Well, no one's talking about the dollar-yuan relationship, and since May, the dollar has declined 2% versus the yuan. So actually the yuan has been the strongest currency in the world relative to everything else. But if anything, interest rate cuts again in China, assumption that they would drive the yuan down, which they didn't today. The yuan was steady against the dollar. If anything, that's going to stimulate Chinese exports to the U.S. It's not going to stimulate U.S. manufacturing activity and exports to China, right? So there should have been no translation of an interest rate cut, which no one can probably even explain what it means over in China. There should have been no translation between that event and me waking up and seeing the S&P futures up 18 points.
Yeah, and
it again just speaks to how insane and irrational our system is right now. And again, as Eric points out, I think it's an indication that we're in an advanced stage of collapse.
Yeah, and the transmechanism, the mechanics of seeing our stock market go up basically follows the logic train of people looking at China saying, oh, they're in a deflationary funk, this is going to help them, therefore it buys more time for the global economic system to continue on the charade, and then everybody feels safe to, not everybody, the speculative forces within investment banks and hedge funds feel safe to go out and continue on this crazy asset inflation fiesta that we're watching.
I think it's all computer algorithm driven, just like what's going on in the paper gold market. It's all computer driven algorithms, hedge fund and bank computers just pushing momentum in one direction.
But computer algorithms only operate when the person or people and the companies behind them allow them to operate, and they're still in the mode of exploiting the opportunity for financial asset inflation because the central banks still have their back, at least the perception of it. And that's
exactly.
That's a good segue for an update on the physical market, which is obviously the one thing that's not algo-driven, and the physical market has really, over the last 2 weeks, just exploded into the type of shortage we saw in early 2013, and probably even worse than we saw in 2013. I mean, it's not quite as bad yet as we saw in 2008, but it obviously began several weeks back with the U.S. Mint suspending Silver Eagle sales. This week they did resume Silver Eagle sales on an allocation, but they won't give any news as to how long. The Canadian Mint this week has begun really strict allocation. I'd expect in the next week or so, Silver Maple's prices are going to actually be higher than Silver Eagle's due to that. And then on the private mint side, the Sunshine Mint, which supplies the blanks for the Silver Eagle program, any the rounds or bars if you're purchasing from Sunshine, it's nearly an 8-week delay. So dealers are placing orders now. You'll be lucky to get your product in February. And it's not just the Sunshine Mint. We're seeing it across the private mints, whether it's 100-ounce bars, 10-ounce bars, rounds. Everything is anywhere from 2 to 4 weeks out. Just production is backlogged that much. And we're seeing it in 90% too. The 90% is pretty much gone across the wholesale market. If you can find it, wholesale premiums are over $2 an ounce. So it's definitely the tightest situation we've seen in a while on the physical side in silver, and it's been quite amazing how fast it developed when silver broke under 16.
Sounds like it's the tightest it's been since 2008.
I think it probably is.
Remember that? Remember how tight it? I mean, Silver Eagle premiums were as high as 40% back then.
Yes, I remember they were, I want to say $6.99 over spot for a while when you're buying in quantity, like around a box. So we haven't seen that, thankfully, yet, and it hasn't worsened over the last couple of days as silver has obviously bounced this week off of the lows in the lower 15s, but the demand has continued to be extremely, extremely strong. And what's interesting is we're having, just anecdotally with SD Bullion, we're taking phone calls from customers who have never purchased silver before, and they're putting substantial investments into silver. Just yesterday evening, a customer never bought an ounce of silver in his life and puts down $250,000 worth of physical silver. So just anecdotally, it's interesting that we're seeing new people to the market making large investments, and it wouldn't take very many people across the U.S. to do that, and there's not going to be any silver to be found.
It's interesting.
I'd like to kind of talk a bit about where we are in our bigger picture in the marketplace, and just fill in some gaps, because we actually recorded a couple of shows this month and put them in a can, and Doc took a nice vacation, and we did this with gold referendum story and recorded that in advance as well too. And it's important to note that we probably are still going to see this burst in our financial assets going through the holiday. Investors will recall that we had a pretty big correction in the stock market, and the Dow went down mid-October and lost quite a bit of steam. It went down on an intraday basis over 9%, and that's when the Federal Reserve Board governors like Bullard were coming out and saying, "Hey, wait a minute, all your fears about QE ending, well, don't think so fast. We might change the way things are," and then the market had reflated itself. And back at that time, people were really nervous about this being the big one, and you had all the Kranzler thinkers coming out and long-way cycle people saying, we're going to, hear the stock market basically implode upon itself and whatnot. And it looks like what I was talking about back then about the Dow easily going back over 1,800 by the holiday is in fact going to happen. And it probably will keep going. Dow 2,100 first quarter, believe it or not, can happen. And there's a lot of people in the gold space, precious metals community generally speaking, who get overly bearish to the point of not recognizing the power of this reinflation trend that comes from these central bankers going mad. And I just want to put that out there as a point of caution, because some forecasting is really about assessing the probabilities of events. And anyone who comes out and says, my accuracy is X, Y, and Z percentage or whatever, is really kind of missing the point. It's mature people in the industry that make forecasting for a living look at it far more soberly than that. And it's really just a question of trying to assess the probabilities of what will happen in the future, and you're necessarily going to get things wrong. And a lot of times when people do get things wrong, the cat calls come from the peanut gallery, and it's unfortunate because they miss the actual, the signal importance of trying to go through the exercise of assessing these probabilities. And frankly, I think we're going to see a blow off top in the general equities market. We're going through it right now. It's going to continue through the holiday season. We're probably going to have a pretty decent holiday season, and reports about it are going to be even more excessively aggrandized over what reality is, because the vast majority of it is going to be driven by consumers just going more into debt. But we're shaping up for a really rocky 2015 because of all of this, because of the degree to which we are inflating. It's very dangerous. And, maybe it is the case that new people have come into the precious metals market because in keeping with the theme that Dave and I and Doc have been talking about in this show, is that it does feel like we're advancing along in the end game. And we'll talk about that more in the weeks ahead on our show. But it's something that needs to be thought about by people as we go through this whole cycle of the financial markets going ever higher and higher, and it's going to be a lot more lunacy in the immediate weeks ahead. So stay tuned. We're probably going to see, a short-term correction sometime between now and the holidays as well in the stock market. I agree with you. What's going to happen as well.
I agree with you in general, but I don't know if we're going to see a correction. I think the Fed is not going to let the stock market fall at all until after the holiday season, because and again, I don't think that the retail sales are going to. I don't think you're going to see stellar retail sales this year. I mean, yeah, I think people are going to go more into debt, but I think in order to buy some things, but I think that it's going to be kind of reluctant, because the U.S. is already levered up by an extreme degree. If you go look at the debt numbers on the St. Louis Fed website, you can see, I mean, the credit card credit card and overall individual debt is starting to go parabolic. So, and that, you know, we know that's true with auto loans, especially with subprime auto loans, which are already starting to default in quantities, significant quantities. So, I don't know that retail sales are going to be great, but if the stock market drops, or if the Fed were to let the stock market drop, it'd be a sure way to wipe out the retail season. And that's why I don't think we're going to see that happen.
Yeah, I think one of the reasons why I'm going to take a different perspective on this is you're going to see consumers feeling a little bit more liberal with their ability to go into credit because of the falling gas prices and just the whole propaganda that's out there when it comes to pushing people to feel like the economy is better than it really is. And again, this fits into the thesis of being in the end game, and that the 2015 is probably, in my estimation, going to be a time where we're going to see some huge turmoil in the marketplace.
Well, don't forget that people are going to start seeing their Obamacare premiums go up. We've already seen an example of that was posted on Zero Hedge this week.
Yes.
So that may well offset the quote unquote wealth effect of a lower gas price.
Yeah.
So I think you're going to see retail sales at the high end be really robust. Tiffany's and Saks and Bergdorf's and, you know, that side of it. You probably see a lot of Lexus sales, but I don't think you're going to, at the mainstream retail companies, I don't think you're going to see robust sales. I don't even know if you're going to see an uptick, and that's why we're already seeing Black Friday. Basically, they should just rename it Black November, because you're already getting Black Friday prices, you know, that kicked in at the beginning of November.
Yeah. Just to be clear, because I don't think you understood exactly the time frame and the sequence that I was speaking of. The healthcare premium hikes will come in the mail largely after the holiday season. They'll get some out before, but most people are not going to see that hit them until we're in 2015 already. And frankly, that's actually going to fit perfectly with the comeuppance that is going to happen in 2015 when people come dealing with the hangover of the malinvestments that have been created in the financial markets and the propaganda-driven perception that everything is still okay. And people, you know, I agree with you. I think that overall the retail season is going to be pretty just not very great when it comes to the average person. But the perception of it, the spin of it, that will in fact drive the stock market, because the participants in the stock market are not the same people going and doing the shopping, will nonetheless help the financial assets move through the whole 2004 remaining time frame with kind of a blow-off top. So it'll be interesting to see what happens, but I think
you can have a blow-off top without having good retail sales. I mean, the stock market's so far dislocated from reality. All it takes is the Fed, going in there and juicing the S&P minis, and then the hedge funds pile in, and that, again, that's what the unsterilized printing of yuan is being used for.
Yeah.
So, and again, they're gonna, with or without good retail sales, they're gonna push the stock market higher, in my opinion.
Well, next week will be an important one for the metals here. While many are probably looking for the gold repatriation story to have a positive impact, let's not forget that it'll likely be a pretty thinly traded week with the Thanksgiving holiday in the U.S. and with gold here closing the week in the access markets, the futures markets here in the U.S. right at 1,200. Don't be surprised if the bankers take the opportunity of thinly traded markets to attempt to keep gold capped under 1,200 and silver under 1,650. Again, is right here in the futures markets, we have gold closing right at 1,200, although the Kitco charts that a lot of people refer to are showing a bit over 1,200. And I knew you were talking about that before this show, Dave.
Yeah, this is one thing that's driven me nuts for years, and everyone has just gotten used to referencing Kitco as the spot price reference, and Kitco's price is not a spot price. I mean, technically, the true spot price is the AM and PM London fix. That's your true spot price, and then the futures and forwards levels are derived from there, and that has to do with interest rates, time value, etc. The price that you see on Kitco every second is derived from the most recent London fix, whether it's the AM or the PM, and then they've got a mathematical calculation that involves forward prices, future prices, and interest rates. And I used to know what the algorithm was. My colleague Jesse of Jesse's Cafe Americain, he wrote an article about it probably 5 or 6 years ago, and he actually contacted Kitco to find out what the formula was, and it's a mathematical formula. It's not the true spot price. I mean, really, the true spot price of gold is whatever price the last unencumbered 400-ounce bar of gold, whatever price was transacted between a buyer and seller of that bar, right? Now, if China came into the market and said, I want an offering of 100 tons of gold, all or none, offer wanted and comp, I think we'd see an entirely different spot price occur. and Kitco would be left in the dust. So that's just to clarify that Kitco is not the true spot price of gold.
I think the readers will really appreciate that explanation, because I know we get asked that question numerous times every week. So I know a lot of our listeners likely have that question. So that's a great explanation, Dave. Well, it was great to have you back on the show, Dave. Come back anytime.
It's great to be here.
All right.
Always great talking to you guys.
All right, so again, thinly traded market next week. I personally expect to see the metals attempted to be capped, but we'll see with gold and silver closing right near important levels around 1650 and 1200. So for the Doc and Eric Dubin, Dave Kranzler, thanks for tuning in to the SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They used the word orderly. As long as it's orderly, it seems to be okay.